All right, looks like we've got a pretty hefty stack of info here, all about stock splits.
Yeah, looks like someone's really trying to get a handle on what they are, why companies do them, and how they affect investors.
Definitely seems like they're looking for the full picture.
It's easy to think stock splits are just about, making a stock's price look a bit smaller.
Right.
But there's a whole lot more going on under the surface, so let's unpack that.
That's why we're here.
Yeah.
Right. Digging into the details. So before we get too far, I think it's important to start with the basics. What exactly is a stock split?
Well, you can think of it like cutting a cake.
Okay.
You end up with more slices,
Right.
but the cake itself is still the same size. A stock split is kind of similar. You get more shares, but each share is worth proportionally less.
So the total value, though, stays the same.
Exactly. Your total investment value doesn't actually change.
Makes sense. So it's not about changing the actual value of the company. It's just changing how that value is divided up.
You got it. It's a redistribution, not a change in the company's inherent worth.
Okay, I'm with you so far. So then why would a company even bother with a stock split if it doesn't change their value?
Right, you'd think it wouldn't matter much, but
There's a but coming. I can feel it.
there is. On paper, a split shouldn't change anything value-wise, but often it does impact the stock price, at least in the short term.
So there's something more at play here, more than just the simple math.
Absolutely. There are several theories about why companies go for stock splits, and a big one is this idea of getting the stock into a good trading range.
Okay, so what exactly does trading range mean?
Well, it basically means keeping the price of a single share within a certain range that is, well, appealing to investors. Historically, this sweet spot has been around, I'd say $30 to $40 a share.
So companies are kind of manipulating the price to make it more attractive then.
Well, not manipulating exactly. It's more about making it more accessible.
Okay.
Think about it. A stock priced at, say, $1,500 a share might seem out of reach for a lot of investors.
Right.
But split that stock 10 for 1,
Uh,
suddenly it's trading at $150 a share.
and it seems a lot more doable, even though, like we said, the company's value hasn't actually changed. It's kind of fascinating how that works.
It really is. The synology of pricing is pretty powerful.
So is that the main reason for splits, or are there other factors at play?
Oh, there's definitely more to the story. Attracting new investors is another big reason, especially retail investors who might not have the capital to buy those higher priced shares.
So it's kind of like opening the doors wider to, well, to a bigger pool of potential buyers.
Exactly. And that leads to another important factor, increased liquidity.
Okay, so more shares available equals.
It means it's easier to buy and sell the stock, which can be good for the company and for investors.
So win-win, it sounds like.
Pretty much. Now, let's not forget about the signaling effect.
Signaling.
A stock split can actually be a way for a company to say, hey, we're confident about our future growth.
It's almost like they're saying, we expect our stock price to keep going up, so we're going to make it easier for more people to get in on the action.
You got it. It generates buzz, it can attract attention, and all of that can drive up demand.
So we've been talking about the most common type of stock split.
Yeah.
The forward split.
Right.
But what about those reverse stock splits?
Oh, yeah, reverse splits. Those are a whole different ballgame.
Mm-hmm.
Instead of increasing the number of shares, the company actually decreases them.
And that means?
The price per share goes up proportionally.
So why would a company want to reduce the number of shares out there? Seems counterintuitive.
It often comes down to trying to avoid being delisted from an exchange.
Delisted.
Yeah, you see, if a company's share price drops too low, it runs the risk of being delisted from the exchange.
And being delisted makes it harder for the company to do what?
Well, it can make it tougher to attract investors and to access capital.
So a reverse split is kind of like a way to bump that share price back up. Like to stay in the game, so to speak.
Exactly. Now, there's actually another kind of split that's even more complex, a reverse forward combo split.
Ooh, combo split. That sounds interesting.
It's a two-step process.
Okay, so walk me through it.
First, the company does a reverse split, which, like we talked about, reduces the total number of shares.
Uh-huh.
Now, this can actually lead to some smaller shareholders being cashed out.
Oh, how so?
Well, if their holdings fall below a certain amount, they might get cashed out.
I see.
Then, the company follows that up with a forward split to increase the number of shares again, for the remaining shareholders, of course.
So it's kind of like, I don't know, consolidating things, bringing the bigger players closer together.
You could say that, and there are various reasons why a company might want to do this. Simplifying things on the shareholder side, maybe cutting some administrative costs.
Streamlining things a bit.
Exactly. It can even be a way to attract those larger institutional investors.
Okay, this is all fascinating stuff, but we've only just dipped our toes into the psychology of how investors react to all of this, and I think that's where things get really interesting.
You're telling me, buckle up. When we're talking about stock splits, we really got to talk about investor psychology. We like to think we're all rational actors out there,
Yeah.
but behavioral finance tells us that, well, our emotions can really drive our decisions, especially when it comes to money.
Oh, yeah? Can't argue with that.
hmm
I'm sure we've all made those impulse purchases that seemed like a great idea at the time.
Exactly. And one of the big psychological factors at play with these stock splits is this thing called the nominal price illusion.
Nominal price illusion. Okay, that sounds kind of complicated.
It's actually pretty straightforward. It basically means that people tend to think they're getting a better deal if they see a lower price per share,
Even at if.
even if the company's total value hasn't changed at all. Think of it like seeing a shirt on sale for $25 that was originally marked at $50.
Okay, yeah,
You feel like you're getting a bargain, right?
for sure.
Even if that shirt was never really worth $50 in the first place.
Oh, I get it. It's like you're tricking your brain into thinking you're getting a steal.
Exactly. And this whole illusion thing gets even more interesting when we consider the rise of fractional share investing.
Oh, yeah, good point. You don't have to shell out hundreds or even thousands of dollars to buy a full share of, like, an Amazon or a Google anymore.
Right. You can buy just a fraction of a share for a much smaller amount.
So you'd think stock splits wouldn't even be that necessary anymore.
You would, wouldn't you? But here's the thing. They still have a huge impact on how people feel about buying stock. That lower price tag, even if it's kind of an illusion, it can be really persuasive.
So even in today's market, where you can buy fractions of shares easily, this pricing psychology still rules.
It does. The nominal price illusion, that's just one piece of the puzzle, though. There are a bunch of other biases that can creep in when investors are looking at stock splits.
Okay, I'm all ears. What else should we be watching out for?
Well, there's something called anchoring bias.
Anchoring.
People tend to fixate on that pre-split price, so anything lower than that, they see it as a gain, even if it's just an illusion.
So even though the total value is the same, that lower per share price makes it feel like the stock's on sale?
Exactly. And then you've got overconfidence bias. Investors might think they're, well, smarter than the market and can take advantage of the split in a way others can't.
It's that beat the market
He
mentality.
nailed it. And of course, we can't forget about the good old gambling mentality. That lower share price can make some investors feel like they're playing the lottery, like they have a chance to win big.
It's like that lower price somehow reduces the risk in their minds.
It can feel that way, even though that's not really how it works.
It's a pretty powerful combination, huh?
Yeah.
Emotion, perception, maybe even some wishful thinking.
You said it. Now, let's say you're an investor and you're watching a company that's getting ready to do a stock split.
Yeah.
There are a few key dates to keep in mind.
Okay, let's break those down. What dates should we be marking on our calendars?
First up, you've got the announcement date.
Announcement.
This is when the company officially says, hey, we're splitting the stock.
So this is when you start seeing those headlines.
Exactly. And the buzz starts to build.
The market's officially on notice.
Right. Next comes the record date.
Record date.
This is like the cutoff date to be eligible to get those new shares after the split.
So I got to be in before the record date to get in on the action.
Yep. And finally, you have the distribution date.
Distribution.
This is when the split actually happens. All those new shares, they start trading at the adjusted price.
It's like a three-act play almost.
Yeah.
The announcement gets everyone excited, the record date sets the stage, and then the distribution date is the big finale.
I like that. Now, we've mainly been looking at this from the investor's point of view, but it's just as important to think about, well, what are the upsides and downsides for the company when they decide to split their stock?
Great point. Let's flip the script a bit. What are some of the advantages for the companies themselves?
Well, we already talked about attracting more investors, right?
Right.
A lower share price can make it easier for those everyday investors to buy in.
Wider appeal, bigger audience.
Exactly. And then there's the increased liquidity we talked about earlier. More shares floating around, it makes it easier for everyone to buy and sell.
So it's good for the company because it makes their stock more attractive, and it's good for investors because they can trade more easily.
Right on. And then there's that signaling effect again.
Oh, yeah. The company saying, we believe in our future.
It can be a powerful way to communicate confidence to the market.
So are there any downsides for the company?
Of course. It's not all sunshine and roses. One thing to consider is the cost.
Cost.
Yeah, stock splits aren't free. You've got legal fees, paperwork, all the communication with shareholders. It adds up.
So there's a whole process behind the scenes.
There is, and it can get pretty pricey.
Yeah.
Another potential downside is, well, the risk of increased volatility,
Volatility meaning.
meaning the stock price might jump around more.
I see.
When the price per share goes down after a split, it can sometimes attract, more speculative trading, and that can lead to wider price swings.
So even though a split might create buzz and bring in new investors, it could also make the stock price a bit more, well, unpredictable.
That's definitely something to keep in mind. And then there's the fact that the excitement around a stock split, it doesn't always last.
It can fizzle out.
It can. If the company doesn't perform the way everyone expects, that initial boost can fade pretty quickly.
Like a sugar rush.
Yeah.
A quick burst of energy, but it doesn't last.
Perfect analogy. The main takeaway here is that stock splits are a strategic decision for companies. There are potential benefits, but there are also some risks to consider.
It's a balancing act for sure. They need to weigh the pros and cons carefully. Now, I think it would be helpful to see how this all plays out in the real world.
Absolutely.
Can you think of any examples of companies that have used stock splits effectively?
Sure. Let's take a look at NVIDIA. They've been in the news a lot lately.
Yeah.
And they've actually done a couple of splits recently. A 4-for-1 split back in 2021, and then a 10-for-1 split in 2024.
Wow, I knew NVIDIA was a big player, but I didn't realize they'd done splits that recently. What was behind those decisions?
Well, both times, NVIDIA's stock price had been, it had been skyrocketing.
Makes sense.
Their shares were getting pretty expensive, which, as we've discussed, can make it hard for some investors to get on board.
So they were trying to open things up to a wider range of investors and increase liquidity.
You got it. And it's interesting to note that after both of those splits, NVIDIA's stock price kept going up.
So the splits didn't seem to hurt their momentum.
Nope, not at all. Of course, that doesn't mean the splits caused the price increases.
Right. Correlation doesn't equal causation.
Exactly. But it's still an interesting observation. Now, before we wrap up our stock split deep dive, there's one more important topic to touch on.
Oh, yeah. Taxes.
The dreaded taxes. But in this case, there's good news. In the U.S., at least, a stock split isn't considered a taxable event.
So no need to worry about Uncle Sam taking a cut when those shares multiply.
Nope. It's really just a rearrangement of your existing shares, not a realization of gains. Your cost basis adjusts, and you don't owe any taxes until you actually sell those shares.
So good news for investors, for sure. Well, we've covered a lot of ground here, from the basics of what a stock split is to the sometimes quirky psychology that shapes how investors behave.
We sure have.
What are some of the key things you'd like our listener to walk away with today?
Well, I think the biggest takeaway is that stock splits are, they're interesting, they can have a real impact.
Yeah.
But they're really just one piece of a much bigger puzzle.
Right. Don't get so focused on the hype that you forget about the bigger picture.
Exactly. You always want to be looking at the company's fundamentals.
Right. Their financial health, how they're growing, what their long-term strategy is.
All of that. A stock split, it might be a sign that the company's feeling confident,
Yeah.
but it's definitely not a guarantee of future success.
I think that's a really important point. Do your own research, understand the company, make sure your decisions align with your own investment goals and your risk tolerance.
Right. And don't let all the excitement around a split lead you to make a decision you might regret later.
It's easy to get caught up in the moment, for sure. Well, I think we've done a pretty thorough job unpacking this whole world of stock splits.
I think so. We covered the mechanics, the psychology,
The pros, the cons, even the tax side of things.
and we looked at some real-world examples, too.
Definitely. Hopefully our listener is feeling a lot more informed about this fascinating corner of the market.
I hope so. And remember, if you're ever feeling uncertain, it's always a good idea to talk to a trusted financial advisor.
Sound advice. Well, I think that about wraps up our deep dive into stock splits. It's been great exploring this with you. And to our listener, thanks for joining us. Until next time, happy investing.